How does a credit card work? You swipe a piece of plastic at a coffee shop. 5 seconds later, money pays for something you don't actually have the cash for right now. No one asks if you have a balance. No one checks your bank account. The transaction just happens. But in those 5 seconds, here's what really happened. 4 different companies made money from you. A bank in Mumbai took a calculated risk. And you started a debt timer that could end up costing more than your rent. Let's rewind. A credit card is not a payment tool. It's a very small loan that resets every month. And the entire system is designed so you forget that. When you hand over your card, you're not spending your money. You're spending the bank's money. HDFC, SBI, Axis, whoever issued the card, they paid the coffee shop on your behalf. They made the payment up front. And now you owe them. But the question is, why would any bank pay for your coffee, groceries, or flight tickets without knowing for sure whether you'll pay them back? Because they've already done the math. And that math is brutal. Now let's understand what actually happens when you swipe. First, your card talks to a payment network. Visa, MasterCard, RuPay. These companies don't issue cards. They just run the rails. Like mobile towers connecting your bank to the shop's bank in milliseconds. The shop's bank, called the acquiring bank, sends a request to your bank, the issuing bank. Your bank checks. Is the card valid? Is it active? Is there credit limit left? If the answer is yes, the bank approves the transaction. The payment network sends the approval back. The coffee shop gets a green light. You get your coffee. Total time, 3 to 5 seconds. No one explains this at the counter. The coffee shop doesn't receive the full amount. Suppose the coffee costs 100 rupees. The shop receives 97 rupees or 98 rupees. Where did the rest go? The payment network took a cut. The acquiring bank took a cut. The issuing bank took the biggest cut. Sometimes a payment processor takes a share too. This is called the interchange fee. You never see it, but this is the real reason credit cards exist. Banks don't give credit cards out of generosity. They give them because they earn money on every swipe, even if you pay your bill on time, even if you never pay interest. Now the real game begins. Most people don't pay the full amount on time. The credit card business is built on a simple bet that you'll forget, delay, or won't have the full amount when the bill arrives. Let's say your billing cycle closes on the 15th. Your bill is 10,000 rupees. You have until the 5th to pay in full. This is the grace period. 20 to 25 days. If you pay the full 10,000 rupees on time, zero interest. You used the bank's money for free. You win. But if you pay 9,000 rupees instead, everything changes. The 1,000 rupees you didn't pay starts attracting interest. Not from today, from the day you bought that coffee. Retroactively. Interest rate? Not 5% or 10%. 36% to 42% per year. That's about 3.5% per month. With compounding. Now let's do the uncomfortable math. 1,000 rupees is outstanding. You think, I'll pay it next month. Next month it becomes 1,035 rupees. You pay 500 rupees. The rest keeps growing. By the 3rd month, you're paying interest on interest. This is where people get stuck in credit card debt. Not because they're careless, but because partial payment feels harmless. You keep using the card. Swipes continue. The balance grows. The minimum payment due is just 5%. You pay that. It feels manageable. But that 5% doesn't even cover the interest. You're paying the bank just enough to stay in debt. Now you see why banks love this game. Credit cards are the most profitable product in retail banking. The number of people who completely default is small. Most people pay something, and that's where the money is made. A 50,000 rupees balance running at 40% interest earns the bank 20,000 rupees in a year. From just one cardholder. Now multiply that by millions. And even if someone fully defaults, the bank has already covered its risk through interchange fees, interest, late fees, and annual charges. The house almost always wins. But here's the twist. Credit cards aren't evil. They're neutral technology, just with very sharp edges. If you pay the full amount every month, every time, a credit card is a free loan. Cashback, reward points, airport lounge access, fraud protection. If the card is stolen, zero liability. Your credit score improves. You get leverage in emergencies. Your spending is tracked. It's genuinely useful, but the entire business model depends on the fact that most people won't use it this way. Banks sell credit cards as a lifestyle upgrade. Premium, exclusive, platinum, but the profit comes when you slip. When you carry a balance. When you forget the due date. When life gets in the way and you make the minimum payment. So what does this mean for you? Using a credit card is like walking a tightrope. On one side, convenience and benefits. On the other, a debt trap that slowly tightens. The system isn't broken, it's working exactly the way it was designed. What's the biggest trick? All of this feels normal. Everyone has a card. Swiping is effortless. The bill comes later. The pain is delayed. The interest stays invisible, until it becomes very visible. One question no one asks. If credit cards are so good for customers, why do banks spend crores on marketing to get you to apply? Because they've seen the numbers. And they know how most stories end. That coffee wasn't just coffee. It was the start of a very expensive timer. And now you know what's on countdown. If anything wasn't clear, leave a comment. And if you keep seeing videos like this on our channel, don't forget to subscribe.